Ever found yourself intrigued by the profound mechanisms of the Federal Reserve? On moments of curiosity like these, we seize the chance to unravel the enigma that is the Federal Reserve. A query as frequent as this warrants a response, and that's exactly what we're setting out to do today. We're about to embark on a journey to the core of America's financial infrastructure, unveiling the crucial and inspirational role of the Federal Reserve. In essence, the Federal Reserve, affectionately coined the Fed, is essentially the central system of the United States. But this plain description barely encapsulates its importance. The Federal Reserve is a complex combination of diverse entities, each possessing distinctive roles and duties, shaping the economy of the nation with unflinching dedication. Born in the dawn of the 20th century, in the exact year of 1913, the Fed stands firm as the steadfast protector of our nation's financial health. The creation of Fed was a countermeasure to the series of financial crises that shook the economy's foundation during the preceding years. The mission was unambiguous: to undeterredly shield the economy from similar crises and to soften the impact when they did occur. Visualize, if you can, a human heart diligently circulating blood to manage the body's functions. The Federal Reserve serves a parallel role for our nation's economic health. Just as the heart ensures the delivery of oxygen and nutrients to every cell, the Fed ensures the fiscal sustenance reaches every segment of the Federal Reserve accomplishes this through a myriad of ways. It decides the interest rates for banks' overnight lending to each other. It buys and sells government securities to regulate the money supply. It supervises and governs banks to ensure they are secure havens for people's savings. And during tense financial periods, it acts as the ultimate safeguard, stepping in to prevent panic and maintain financial stability. This is the Federal Reserve, a beacon of financial stability and economic prosperity. A stalwart institution that tirelessly ensures the American economy functions seamlessly and proficiently, guaranteeing that the cogs of our nation's economic machinery never falter. Its relentless pursuit of stability and prosperity is truly inspirational, shaping our nation's economy and guarding it as a faithful sentinel. The Federal Reserve, colloquially known as the Fed, has been entrusted with a threefold mission: to maximize employment, stabilize prices, and moderate long-term interest rates. These are the key parameters that govern its functioning, and they are referred to as the dual mandate. They act as a compass, guiding the Fed's various actions and policies with the aim to foster economic stability and growth. The first part of this mission, maximizing employment, is a critical objective. But what does it mean exactly? It's not about striving for zero unemployment, which is a utopian concept, virtually impossible to achieve in a dynamic economy characterized by constant flux. Instead, it's about striving to reach an optimal level of employment, a point at which those who are willing and able to work can find suitable jobs. It's about creating an environment where businesses can thrive and grow, expanding their operations and creating more job opportunities, thereby reducing the specter of unemployment. The Federal Reserve, through its monetary policies, strives to ensure that the workforce is gainfully employed, that there are minimal job layoffs, and that businesses are given the necessary impetus to grow and prosper. It undertakes measures to stimulate the economy, to inspire businesses to invest more, to innovate more, and to hire more. After all, a fully employed workforce is a powerful engine of economic growth and stability. The second pillar of the Fed's dual mandate is price stability. You may have observed that the prices of everyday goods, like a loaf of bread, don't drastically fluctuate from day to day. This is no coincidence. It's the result of the Fed's constant vigilance and intervention. By controlling inflation and preventing deflation, the Fed ensures a level of price stability. Imagine the chaos if prices were to rise and fall unpredictably. The value of the dollar in your pocket would become an uncertainty, undermining consumer confidence and potentially wreaking havoc in the economy. By keeping inflation in check and averting deflation, the Fed seeks to maintain price stability, thereby ensuring that the dollar in your pocket holds its value over time. It's not just about maintaining the purchasing power of your hard-earned money, but also about fostering an environment of economic predictability and stability, where businesses and households can plan for the future with some degree of confidence. The third pillar of the Fed's mission is moderating long-term interest rates. Through its influence over these rates, the Fed can encourage or discourage borrowing and spending. Lower interest rates might spur spending and investment, acting as a stimulus for economic growth. On the other hand, higher interest rates can be used to cool down an overheated economy, preventing it from veering into the danger zone of inflation. The Fed influences these rates to encourage or discourage borrowing and spending. Lower rates might spur spending and investment, while higher rates can cool an overheated economy. So how does the Federal Reserve, popularly known as the Fed, accomplish all of this? This brief question often raises a considerable amount of interest, and rightfully so. It is the kind of question that entails an answer that is both intriguing and comprehensive. Well, the answer lies in the Fed's toolbox. The Fed employs a number of key tools, a few of which warrant our immediate attention. One of the most prominent tools used by the Fed is what is called open market operations. These operations are essentially a series of intricate transactions in which the Fed buys and sells government securities. But what does the buying and selling of government securities have to do with the economy? Actually, a lot. When the Fed buys securities, it essentially injects money into the economy, making more money available for banks to lend to consumers and businesses. This in turn can spur economic growth. On the other hand, when the Fed sells securities, pulls money out of the economy, thereby reducing the amount of money available for lending. This can help slow down an economy that's overheating. In addition to open market operations, another significant tool in the Fed's arsenal is the ability to adjust the reserve requirement. The reserve requirement is the amount of money that banks are obliged to hold in reserve. This isn't just a random figure, it has a decisive role in the economy. By changing the reserve requirement, the Fed can influence how much money banks can lend. If the reserve requirement is increased, banks have less money to lend, which can slow down economic activity. Conversely, if the reserve requirement is decreased, banks have more money to lend, potentially stimulating economic activity. But the Fed doesn't stop there. It holds another significant lever over the economy in the form of the discount rate. This is the interest rate charged to commercial banks for loans obtained directly from the Federal Reserve itself. By altering the discount rate, the Fed can influence borrowing costs, which in turn influences the pace of economic activity. When the discount rate is increased, borrowing becomes more expensive and economic activity can slow down. Conversely, when the discount rate is lowered, borrowing becomes cheaper and economic activity can speed up. The Fed can also alter the discount rate, the interest rate charged to commercial banks for loans obtained directly from the Federal Reserve. To summarize, the Federal Reserve is like the heart of the U.S. economy, pumping money and adjusting interest rates to maintain economic health. Acting as the central banking system of the United States, it ensures the smooth functioning of the economy. It's a powerful force managing the economy's circulation of money, just as the heart manages the blood circulation in the body. The Federal Reserve System was established in 1913, and since then, it has been working tirelessly to ensure the economic stability of the country. It plays a pivotal role in the economy, employing a multitude of strategies to manage and control the money supply. Its primary aim is to promote the goals of maximum employment, stable prices, and moderate long-term interest rates, thereby ensuring a steady and consistent growth of the U.S. economy. Its strategies are complex, but can be understood if broken down. The Federal Reserve uses tools such as open market operations, where it buys and sells government securities to control the money supply. It also adjusts reserve requirements, which are the amounts that banks must hold in reserve against deposits made by them. This gives it a significant influence over the amount of money that banks can lend. In addition, it also controls the discount rate, which is the interest rate that banks pay to borrow money from the Federal Reserve. By manipulating these tools, the Federal Reserve indirectly controls the country's money supply, influencing the economy's overall health. Unveiling the workings of the Federal Reserve might seem daunting, but understanding its role and function is crucial for any citizen. Its operation is like a well-oiled machine, complex but efficient. It's not just a financial institution, but a dynamic and responsive entity, adapting to the ever-changing economic environment. It's the silent engine that tirelessly works behind the scenes, adjusting and fine-tuning the economic gears to keep the U.S. economy on track. The Federal Reserve's impact can be seen in every aspect of the economy, from the job market to the price of goods and services. Its influence is pervasive. Every decision it makes has a ripple effect, impacting the economic landscape at both a macro and micro level. The next time you see a news headline about the Federal Reserve, you'll know exactly what it's all about. And that's the story of the Federal Reserve, the powerhouse behind the U.S. economy. It's a tale of stability, growth, and the relentless pursuit of a prosperous nation.